Yeah, thank you. Good evening, everybody. Just gonna be a brief introduction. So Nathan is our resident financial advisor. He's got us as talk now that's going to hopefully help everybody make some important decisions going forward. So Nathan, you've probably met most people, but just to give a background with Nathan, we've got some funding from Rothschilds, and Nathan will be here helping the community for next, well, 1 year's down, so we've got 2 more years to go. He's done a great job. He's building up a lot of class. A lot of people now know him, and it's been a great asset to everybody. So hopefully we'll all benefit. So Nathan, do you want to go take control now?
Yeah, thank you, Brian. Um, Thanks everyone for coming. As Brian said, the idea really is for me to help everybody with some guidance and education with regards to everything financial, really. Um, I think it's obviously an important part of life, but it's important to the Black community to understand finances. And what I want to talk about today is really it's a very valuable piece of information for everyone going forward, for you and your families. Um, One thing that is always sort of talked about in the African Caribbean community is generational wealth. And it really just starts with very simple things. So we wanted to talk, I wanted to raise a point to essentially make a webinar where you can, it's going to prompt more questions, really, not answer everything, because it's a massive topic. As I built this presentation and this webinar, I realized actually this is such a huge topic, it could probably go over 3 or 4 webinars. And then if there's appetite for that, we'll do exactly that. So what I'm hoping to do is an overview of this topic, give you some realistic things you can do right now, and hopefully prompt more questions, which you can answer or get answered one of 2 ways. The first is just by prompting myself, Brian, Melissa, just say, look, this is an area that I would like to know more about, and we can do another webinar. And the second is book a one-to-one meeting with myself, and I'll put some details at the end. There's some details on the screen now, but I'll put some details at the end. You can contact me via WhatsApp, via email, book a one-to-one conversation, and we can have a more in-depth conversation about your specific circumstances. And that's really what my role is with Wimco, is to try and help people individually understand how to make better financial decisions. And like I said, this is a massive topic, right? So I want to start off by just explaining, well, one of the reasons why this area of financial planning has become so popular in recent years. Just to give you some headlines, inheritance in England is expected to peak in 2046, reaching about 230 billion. So what we're looking at is probably one of the biggest transfers of wealth from generation to generation for, probably over a century. Roughly 7 trillion pounds will transfer between generations over the next 3 decades, right? 7 trillion pounds. And 70% of wealthy families lose their wealth by the second generation, and up to 90% of families lose their wealth by the third generation. Now, if you were to, these are just numbers given by generic research done in the UK by a few different firms. But I believe that if you were to do that just around Black and brown people, number would be a lot higher. And I think is the government understands this big transfer of wealth. They know that's coming. And that's why I put this number at the front of your screen. On death or assets passed to our estate, the estate must pay 40% in inheritance tax on the total amount. And then the estate keeps the rest. Then the money can be passed to the family. Now that 40% goes to HMRC. Right? They understand that. They know 40% of that 7 trillion pounds is going to them. Now the question is, how do you mitigate that? We're not dodging it, we're controlling it, because this 40% level, this 40% tax has been around since it was introduction back in 1986. So when it was introduced, there were a few different ideas, but by 1988, that 40% tax fee hasn't changed for over just nearly 4 decades. So it's not likely to change anytime soon. But what can change is the way that we plan, and our knowledge and what we know to kind of help that wealth transfer more efficiently. So without the discussion and continued discussions around with our families, especially around financial education, a very small amount of inherited wealth is going to remain with our families. And that may be, some people may say, okay, you know what, that's really none of my business. I want to make sure I'm okay. And with the cost of living and everything, that's important. But the likelihood is that you're not going to spend all of your wealth in your lifetime. It just doesn't always happen. Quite regularly, there's actually quite a lot left in the estate. And we'll talk a little bit about the different structures that can be left in the estate, right? And I've put essentially three of those up. And these are sort of three of the main assets. We won't go into the assets individually or specifically, but an overview is there are, money and assets. There's property, one of the largest areas probably in our community. And there's pension. And pensions can be a little bit complex. There's different types of pension and there's different way they pass down through generations. But around that, we have inheritance tax and how they are all looked at and all taxed after they are passed down. So to narrow this topic down, we're going to cover those 3 points, but to narrow it down, I want to start with what everyone should be doing in the first instance. So this is essential actions for everyone to be doing. This is the bare minimum of what people in our community, and generally speaking, what people should be doing to protect their estate, to control the amount that's passed down, and to make sure you pass down your money in the best and most efficient or tax efficient way, let's say. And the first thing we discussed is another webinar, which is online, so you can go back and watch that. But the first thing is writing a will. Very, very important. And with that, I would add is have the discussion around it. Speak to your families. I know that can be a hard topic to bring up sometimes. People stop speaking and etc. But it's got to be done. A solicitor once told me that often in families there's arguments about the estate, and they happen because those conversations haven't happened before someone has died. They usually happen either towards the end of someone's life or afterwards. And those arguments turn into someone hiring a solicitor to argue their case, and another family member hiring their own solicitor to argue their case. And this lawyer told me that 9 times out of 10, two solicitors are hired, an agreement is formed, but by the time the solicitors are paid their fees, the estate is pretty much gone. And then at the end of the day, who really wins? And that's coming from a solicitor, very, very reputable one towards the end of his career. That's just essentially just saying, look, at the end of the day, what you can do to protect your estate is have a conversation. And in some ways, it's probably the most difficult thing. So a will helps that. A will starts that conversation. It puts a plan in place. It puts it in writing officially. No one can really argue with it. The one thing people do not do is put in storage. Now, paying for storage essentially makes the will worth the paper it's written on, because it can be tracked. If it's lost, if a will is lost, essentially it becomes there basically is no will. So if it's in storage, it can be tracked and traced, and people who wrote it can be contacted. And you can even go on certain websites, pay a small fee just to find out if a will was written in the first place. So write a will, pay for storage. You can get reputable companies to write one. I would always use someone who someone has used before, so take on a referral. And you can come speak to me about this if possible. But yeah, like I said, we've spoken about this in a previous webinar, as well as power of attorneys. But main thing, get a will in place. Second thing, very simple, doesn't cost you a thing to do. Write a list of assets. Write a list of assets and keep it somewhere. Write a list of all your bank accounts, any other policies that you have. And the most important thing to have on that list are the provider names and the contact numbers from your last recent statement. So provider names, policy number, and contact numbers. If that list is available to someone, it makes their life a whole lot easier. So that's the second thing that needs to be done. I know people like to keep a lot of statements, and I'm sure we all have attics somewhere full of pieces of paper. If you have this list, you know to keep a statement from the last 2 years for that particular policy number, and that's it. Everything else can throw away. Some of it will be for companies that don't even exist anymore. As long as you know, I have a policy with this company, and I have a statement from the last 2 years, that's all you need to have as records. Another thing is the beneficiary information. So all those policies should have beneficiary information. So they should be told, or the policy provider should be told, who the beneficiary is and who the money should be going to. This is especially important for pensions, but some policies you won't be able to do that with bank accounts. You can't really put a beneficiary in place. That needs to be a power of attorney, so someone can come and speak on your behalf or on your death. But for pensions, beneficiary information is pretty much essential. So you just have to either fill in a form online to say this is the beneficiary, they will receive the funds 100%, or multiple beneficiaries, but make sure that is done. And again, yes, it's admin, but it doesn't cost you any money to do. Those two things, write a list, put that beneficiary information in place, very, very important. Right, so we'll move on to IHT and allowances and property. And again, I won't go into too much detail. To give you the headline figures. Everything passes to your spouse tax-free. Okay, so if you're married on death, everything goes to your spouse tax-free unless you say in your will otherwise. So generally speaking, the most efficient way to transfer things is pass to the surviving spouse. You can gift directly to your children, but then that starts to eat in what's called the nil rate band. So the nil rate band, this £325,000, is the amount of money on an individual basis everyone can pass down before they pay any tax, before they pay the inheritance tax, excuse me. So if you have nothing else, but you have a bank account with £325,000 in it, and then you die, you're not married, that passes to your family tax-free because it's within the nil rate band allowance. So the government's allowing you to transfer £325,000 to your family tax-free. Anything above that is taxable. But now there are other allowances available. The first thing I would say is, like I said, everything passes to your spouse tax-free. What that means is you're not using your nil rate band on death. So what happens is that allowance transfers to your spouse. So that £325,000 transfers to your spouse so that they have their own £325,000 allowance and their the deceased spouse's £325,000. So they have double the amount, right? £650,000. That happens in every scenario. The next thing to say is that what was introduced more recently in the last couple of years was a residential nil rate band, meaning that if you're passing down a property that you have lived in at some point, you get an extra £175,000 of allowance on your inheritance. Okay. So if you're passing down nothing else but a property and £325,000, you would completely value the estate, but you're allowed to minus off 325 plus 175, £500,000 of asset value that passes down tax-free. And once again, that is for each individual. So if your spouse dies first, that amount transfers to the surviving spouse, and they get double the amount, right? So potentially, the potential allowance is £500,000 each. And if one spouse dies, doesn't pass anything directly to their children, it passes all to their spouse. That spouse now has £1,000,000 of allowance to pass down to their family before they start paying inheritance tax. So £1,000,000 passes down. Anything over and above that amount, you pay 40% tax on, right? So if you've got £1,000,000 passes down, and there's an extra £100,000 left there, that passes down, but you're going to pay 40% on it. So £40,000 taxed, £60,000 passes with the rest of the estate. Those are the headline figures. Now, it can get quite complex depending on the situation. So if you feel like you want to do that calculation now, then feel free to book a meeting with me and we can go through it. Now, it does get a bit more complex, but like I said, I'm going to do a quick overview. But the estate, after the rate, if the estate is more than 2 million, then it starts to tear down. So you start to lose your allowances. Another thing is a 7-year rule, which does apply. The 7-year rule means you can gift money before you die, but it has to be gifted and you have to survive for 7 years before it's outside of your estate completely. And we'll talk a little bit about that later. I'll mention it briefly and we'll go through it. Now, the other thing is, like I said, especially with property, if the estate passes to their spouse directly, there's no tax to pay. If it goes to the children or goes to someone else, then it does start to use your nil rate band or residential nil rate band. Now, one way of that happening is if you have either tenancy in common or joint tenancy on a property that you own with your spouse. Okay? So joint tenancy means you own the property split 50-50. So anything, when one person dies, their share of the property passes over to the other person through interspousal transfer. Or if it's not your spouse, it just passes to that person directly. Tenants in common means that it passes to your state first. It doesn't pass to the other owner of the property, the other shareholder of the property. It passes to your estate first. That means it could go to the children, or if you've got children on different sides of the family, if you've got children before you married, it might pass to them directly. So understanding how that affects your estate, whether your property is in tenancy in common or joint tenancy, is very important. And another thing that was mentioned during the webinar about wills and estates. So I'll go watch that or come and speak to me directly. Right, so let's take it back a notch and just talk about the 7-year gifting rule, which is important, because I would say this is probably the cheapest way to gift money, to transfer funds from your estate. The cheapest way to do that is gifting. Now, all it basically means is you give some money now to your children, as long as it's been 7 years before you die. HMRC aren't going to ask any questions, and that money is outside of your estate. Therefore, it's not included in the calculation. But there's a sliding scale, okay? It's a sliding scale. So essentially, you have to have survived at least 3 years for it to affect the amount of tax you pay on that gift at all, right? But between 3 and 4 years, if you haven't lasted the 7 years, but you're between 3 and 4 years, you only pay 32% tax as opposed to 40%. And basically between 4 and 5 years, it goes to 24%. Between 5 and 6 years, 16%. And then between 6 and 7 years. So if you just didn't make it, You didn't survive 7 years, you'd pay 8% tax on that gift. But over 7 years, then it's not included in the estate. You don't pay any tax or inheritance tax specifically. You don't pay any inheritance tax on that gift. That's important to understand. The 7-year rule is just generally what you should keep in your minds. But understanding there's a sliding scale is important for planning. And especially if you're speaking to a professional like myself, there's ways to mitigate that. And one of the ways, which I'll mention very, very briefly, is by putting insurance in place. So if you felt like you had to make a gift quite quickly, you weren't sure if you're going to survive the 7 years, you might put insurance in place to pay out on death, to pay the insurance at the rate that it's expected to go at. But that you need professional planning in order to achieve. So a little bit about 7-year rule. If you have questions about that, again, book a conversation with me. I mean, the one-to-one meetings are generally to allow you to get financial education and guidance. If you have a question, you need something explaining again, book a meeting, book a call with me, and we can go through it. The last thing I'll mention is pension inheritance tax, right? Now, it's quite complex because there are different types of pension. Now, we've done a pension webinar as well, so go back and watch that. But there are different types of pension: state pension, defined benefit or annuities, which work the same way when it comes to inheritance tax, and defined contribution pension. So most people will have some sort of defined contribution pension because if you're working now, you have to have one in place. You may still have a legacy defined benefit plan if you've been out of the company for a number of years, but most people have defined contribution, or if you work in the civil service or work for the state. But most people will have defined contribution of pension of some kind. So that's the one that I will focus on. Very briefly, I mentioned state pension. So state pension, generally speaking, doesn't get paid to your spouse on death, only in specific circumstances. So if the state pension age was reached before April 2016, so if you were already getting a pension before April 2016, then on death, it might go to the spouse. But generally speaking, state pensions die with you. You die, income stops. Defined benefit and annuities work the same way. It's an income that's paid to you every year, regardless of what the market is doing. It's the same income every month. It might rise with inflation slightly. But it depends on the scheme what the death benefit does. But generally speaking, just assume it dies with you. But what you need to do really is contact the scheme and say, what is the widow's pension? And it may be 50% of it. So some people will put a defined benefit or an annuity in place, and they'll put in something in place with the scheme to say, on my death, I want half of this or a certain percentage to be paid to my spouse. And that's the widow's pension. Most of the time it's 50%, but sometimes it can be more or less. But generally speaking, that policy dies with you. Now, defined contribution pensions. First thing to understand is money is paid to the beneficiary. So this is what I was saying at the top of the webinar. It's very important that you define to the policy provider. So if it's for Scottish Widows, Aegon, Standard Life, doesn't matter. But you tell them you want a beneficiary in place. This is who it is, and this is the percentage they will receive. It has to total 100%, but so if there's two beneficiaries, you might say 50-50. If it's one, you might say 100%. But if they know who that is, then they will contact them on death and say, right, this money is supposed to go to you. And if the death happened before age 75, any money in the pension is paid tax-free. Meaning it's included in the estate for inheritance tax, but it's paid tax-free to the person receiving it. As in, they don't pay the income tax. If the death happens after the age of 75, again, it's included in the estate for inheritance tax, but money is paid to the beneficiary at their marginal income tax rate. So they will pay income tax on the income from a pension that they've inherited. Hopefully that makes sense. But again, if you have questions, get in touch, call the number, send me a message. The last thing to understand is that the pension rules have changed slightly in the recent years. So from April 2027, that's next year, pensions will form part of the estate. So currently they do not form part of the estate. They are outside the estate. So when someone dies, their pension doesn't get calculated in that total amount of money that's passing down, and they won't pay 40% tax on it. But from April 2027, that will be the case. So this is another reason why this type of planning has become quite popular, because money passing down from the estate in the pension is now included in that calculation. And some people are having to pay an extra, if you've got a pension of £100,000, an extra £40,000 potential tax to pay, because the estate, their nil rate band allowance has really been used potentially by their property. Again, a little bit more of a complex topic, but if you have questions, hopefully this has raised more questions. Get in touch, send me a message, and we can go through it. Another thing to say on this is that this is one of the reasons that change in rule that Rachel Reeves brought in to bring pensions inside the estate. That's going to mean one of two things. Either the person's going to say, right, it's not worth keeping it outside the estate now, so I have to use the money in my pensions or spend the money. Therefore, they're going to access more of it and pay more income tax. Or if they don't, it's going to be included in the inheritance tax calculation. So either way, the government wins unless you do the right planning. So I'll finish on this. What can you do now? So what really are your options? What you want to do as a minimum are the things I mentioned at the top of the webinar. Write a will, put a power of attorney in place if necessary as well. List your assets, make sure the provider, policy number, and a contact number is on that list. And also have a discussion with the family about that list as well. Put the beneficiary down on the provider document. So you have to call the provider or fill out a form to make sure the beneficiary is defined as this person will receive the money on my death. Those are the first things. The second things, or the after that, beyond that, the things you could do to mitigate the tax are gifting early. So gifting within that 7-year time frame. So passing money down to the children, using your gifting allowances. So you can use certain allowances that mean you are allowed to gift, and the money is immediately outside of your estate. I won't go through those right now, but again, we could probably do another webinar on this, or you can call me after the questions. Now, I'll put selling down property on there because gifting is a balance. Gifting money out of your estate is a balance, because you don't want to gift all your money away because you can't use it for yourself. And property, you can't do that because you have to sell down the whole thing to be able to gift it, right? You can't gift someone your kitchen, gift someone your living room, gift someone your bedroom. You've got to sell the whole thing and gift parts of it then. So selling down property can be a way to do that. We mentioned in one of the last webinars, equity release, so releasing the money out of the property. That way you can gift it to whoever you want to and keep some for yourself in a more tax efficient way. But basically, property is a very inefficient way to pass down money, especially if it's worth a lot of money. The other thing is insurance. So putting insurance in place, doing protection planning is a way essentially to allow the insurance companies to pay the tax. Now, again, there's a balance here between the premiums you're paying for the insurance and how much is being paid out to pay the tax. So speaking to a professional is probably essential. But generally speaking, you should talk to someone like myself, a financial advisor, to understand how best to gift down your property in the most tax efficient way. So like I said, and like I said all the way through, my work with Wimco is basically to help educate you and provide financial guidance, so give you the right guidance to make the right financial decisions for yourself. A lot of these topics are quite complex, so if you need help, use that number there, send me a message on WhatsApp, book a meeting. It is getting quite busy, and I'm getting quite a lot of messages for that, but that's great, but it's getting quite hard to handle the diary. So what I'm going to say is, book a call with me first. We can talk through things. If we need to meet in person, generally Fridays are the best day. And I'm at the Hilltop Community Centre on most Fridays. Occasionally I can't be there. But on most Fridays I can be there at the Movers and Shakers session. But you can come afterwards and we can have a meeting there in person. So Fridays are the best time to have a meeting in person. But otherwise, send me an email, send me a message, book a call, and ask any questions you need. No, there's no silly questions, no stupid questions. Any question you need, call me, ask me, and get the right guidance. Thank you very much. I'll hand back to Brian just to close out.
Okay, Nathan, well done. Thank you for that. So we'll just open up for questions. If anybody's got a question, feel free to ask a question. I can't see everybody's screen, so you can just come and unmute and then ask the question. So whilst people are thinking, so Nathan, in a scenario of I've got £500,000, I sold, I've got a property of 500,000, and I've got two kids, and I've willed them, I've want to will them 250 each. Okay, is that 325 tax free? Does that relate to both kids, or is it my estate is 325 and then everything above that's taxed?
Yeah, that's right. Good question, Brian. I think the way to think about it is that it passes to the estate first. So
Right.
everything comes into the estate itself pays the tax, and then it gets split between your children, right? So the whatever the total estate is, you keep it whole, you look at the allowances, whatever's left over, you pay tax on, and then whatever's left after that is what's passed to the children. Another thing I would add to that is that's quite important because the estate has to pay the tax first before the money is separated out. Before your children receive their share of inheritance, the tax has to be paid first, which is why it's important to have that conversation and put a plan in place.
Okay. Tracy, you've got a question?
Yeah, thanks very much, Brian. Thank you, Nathan. That was excellent and really helpful. 2 points, if you don't mind. First is corporation, capital gains, not corporation, capital gains tax.
Right, yeah.
So I'm thinking, I've got my house, my husband and I have our house. We'd like to gift it to our son, but we want to continue living in it. But if we gift it to him, do we end up paying capital gains tax?
Okay, there's a couple of things there. So the first thing is on property, you don't pay capital gains tax on your main residence. It's only for investment properties.
All right.
Okay. Second thing is for if you have an asset, it doesn't have to be property, any asset that is yours, and there's a capital gain. So let's just assume they are I mean, you could even think like, say you had a vase that's worth £100,000, right? The vase has increased in value, so there's a capital gain there. But you own it. You die, that capital gain dies with you.
Okay.
Right? And then the resulting value is passed down through the estate. So the capital gain basically dies with you.
Right.
The other thing to talk that you mentioned there is gifting properties. Like I said, gifting property is quite hard to do tax efficiently. One of the reasons is to gift property, it has to be outside of your estate. So you have to gift it and have basically no interest in it whatsoever. So you can do that, but the way to do it is you gift it to your children and then you pay them rent at the market rate. So you pay them rent to live in their property. And it has to be market rate. It has to be recorded so that you can prove to HMRC that it was out of your interest completely, but you were still living there. Now, how efficient that is, I don't have the experience to know. I haven't been in that situation where someone's done that and it has all worked out fine. So I would say be very careful about trying to gift property and living in it, because what's likely to happen is it'll be included in the estate regardless.
Okay, that's great. Thanks. And so, Brian, could I just ask one more question as well, which has suddenly gone out of my head. Oh, yeah. So in my pension, I have already got in that on my death, it will split between my son and my husband. But 50-50. But what happens if one or the other dies? So what happens if my husband dies after
Yeah, so
after this?
is that via the will or the policy documents the
That's the
beneficiary
policy
document?
document. Mm.
Yeah, so it would always take precedent. The will would take precedence,
Okay.
right? So I mean, if it's just your husband and your son, like, and there's
Hmm.
no other family members involved, then everything will pass down to your son.
Okay.
Um, but that also makes changes to how it's looked at for tax, because then it's passing down through the estate instead of by interspousal transfer, meaning
Right.
there's inheritance tax to pay, but you also have the inherited allowances. So because you would inherit your husband's nil rate band, potentially residential nil rate band as well. So there would be more money basically to be able to pass down tax free. Um, so there's a couple of things that happen,
Yeah.
but essentially what we're saying is the will takes precedence. If everything was to go to the husband and then your son, it would all go to your
Mm.
son.
Okay. All right. That's great. Thank you.
Great, no worries.
Any questions? Any further questions?
Yeah, I would
So,
say just like, I mean, again, if anyone has any questions or just wants to engage and ask things, even if it's just a very, very brief question, just feel free to get in touch with me.
oh, and yeah,
By
Andrew's got a question.
details. Yeah, go on, Andrew.
Yeah. Hiya. Evening, everyone. Okay, quick question from me is assets and just say valuable coins and things like that, can they be gifted as well, Nathan, instead of just pure money, as it were? So
Absolutely.
yeah.
Yeah,
Okay.
yeah.
That's good. Okay. Interesting.
And Nathan, just a lot of this has happened in the community. So when someone hasn't formed a will, okay, so it goes to probate,
Yeah.
and then obviously let's say there's three kids. What's the decision? How does the probate work? What do they look at? Do they say, right, all three get it, or do the oldest get who? What do they do normally? What's the rules? Is there rules around who gets what?
Yeah, basically there's the there's kind of the best way to describe it is through sort of a flow chart.
Yeah.
It's funny because so on the webinar about wills in the States, that flow chart I think is presented on that webinar. So if you have the link to that webinar, but this is what something I keep with me. I don't know if you can see that.
A little bit.
No, not really.
Yeah.
I mean, we can make it available just to everybody. I don't know how best to do that, but there's a sort of a number of questions, whether you're married or not, do you have children, then is either of the other parents still living? So there's a number of different questions to ask, basically.
Right.
But so that flow chart will help you answer what happens to the estate and how it passes down exactly. But if there's no will, what often needs to happen is what's called a grant of probate. This isn't my area of expertise exactly, but a grant of probate where you have to go to the courts, get the grant. Oh no, a letter of administration is what it's called. Get a letter of administration to understand how exactly or who controls the estate and how it's going to be passed down according to the intestacy rules. Now that situation is where it can get complex, where the arguments happen and where you basically need to hire lawyers to argue your case as to why you are allowed to receive part of this estate or should receive part of the estate. And that's how estates get dwindled to nothing. So have a look at that webinar because we have an expert on there, Edward Richings, who was a will writer, and he goes through that in quite a lot of detail. But if we can make those a flow chart like I have available to the community, then that would also be helpful to everyone.
Okay. So the key message to everybody here is to spread the word, is to encourage everybody to make a will.
Absolutely. That's the bare minimum you can do. Make a will.
Yeah.
And what would be even better is if there's a power of attorney in place to ensure that as soon as something happens, no one's going into the bank accounts, taking things out. Everything should be locked down, and only the power of attorney can make decisions on that person's assets.
Good. Okay. Okay, great stuff. I don't think there's any more questions. I'm just having a look.
Can I just ask a question?
Cool. Yep.
Yeah, go ahead, Melissa.
I was just trying to think. So it was just with regards to you mentioned that next year, April 27th, will now be included in the estate in terms of inheritance. So is that that's quite a big change, isn't it?
So Melissa, we're breaking up a little bit, but
because I was just thinking that it's always been excluded, but now from next year, the part of my sorry, I can hear you. Okay, can you hear me?
Yeah, you're breaking up a little bit, but I think you're back.
Oh, it's breaking.
Yeah.
Okay. Yeah, no, all I was asking was just with that change coming on board, is it breaking up?
Yeah, okay. So I think Melissa's saying that yeah, with that change, it's actually in fact a huge change, isn't it? Because how do you value a pension? I mean, if you know, because obviously you get an annual pension. So how do they calculate how big that pension is? So I don't know, if you've got $500,000 in your pension, let's say, do they value it as $500,000 or how does it work?
So yeah, so that's why the pension conversation get a bit more complex. I mean, the first thing to say is it's a massive change because pensions are probably the most valuable, if not after property, they're the second most valuable part of your estate. And yet, how it's been previously, it's always been outside of your estate, so it wasn't entered into that calculation. Now, there are different types of pension. There are pensions where you're getting a income and there's not really a value in place. It's just an income every year, right? There are those, that's defined benefit pension or final salary scheme. Those pensions can be valued, but they require a calculation done by an actuary to value the pension first. But if they're in payment, if you're currently receiving a payment, generally speaking, like I said with the DB schemes and annuities, the income dies with you. So the pension's not valued and nothing's passing down to the estate. There's no value there. There's nothing to pay tax on because the income just stops. However, with if the income hasn't started yet, then there's a value there, and it can pass down. But it depends on the scheme. Sometimes it will either say that a widow's pension is paid out, the beneficiary will pay tax on that. It might say there's nothing, so again, the estate it just dies with you. And if that is the case, what you can do if you want to have more control over the estate is essentially turn that defined benefit or final salary scheme into a defined contribution scheme where the actuary calculates the value is transferred out, so you now have it, you have the cash, you have the money, it's invested. And now you no longer get a guaranteed income, but you can take the income that you want from it, which has other implications. But now that value is that will be passed down through the estate. And that is generally speaking, with most people who have pensions who are working, that is the setup they already have. They already have a pension that is valued at a certain amount. If it's worth £500,000, that's what's passed down into the estate. And that will take away the whole of that nil rate band allowance of £325,000. That will use all of that. And anything above that will be charged at 40% inheritance tax. And as I said before in the presentation, there's a little bit of jiggery pokery and understanding exactly what happens and how it's paid, but it depends on when you die, who inherits it, and what their tax rate is, as to how much tax will be paid before they receive the money.
Okay. That's going to be a big win for the government, but everybody else loses, unfortunately.
Exactly. I mean, this is the thing. I mean, by that £7 trillion of transfer that's happening in the UK over the next few years, that's happening. One of the reasons is because of this, by pulling pensions into the estate. And there are many different ways you can do things to protect your estate. But like I said, really what we're saying is that the main way to hide money. I know people think that rich people are hiding money all over the place. No, all they're doing is gifting money they don't need now. Obviously, the wealthier you are, the easier it is to do that, because then you've got money you could just afford to not have an interest in. Trust planning works the same way. All trust planning is just taking the money you have and giving it away, so you cannot access it, you have no interest in it, therefore it's outside of your estate for inheritance tax. Okay? I mean, inheritance tax is, generally speaking, quite a good thing because it stops wealthy families from staying wealthy. But what's happened is that the rules for inheritance haven't changed for years. That 40% tax has been the same every year. And as people have gained wealth, they've been pulled into that bracket and the allowances haven't moved. That's the problem. And the thing is that inheritance tax was brought in 1986, meaning it was probably only brought in when Black people started to build wealth. And now the more wealth we build, the more we're getting pulled into the tax bracket where we're actually paying tax on our inheritance, because now we've got houses that are worth more than £325,000. So it's essential for people in this community to do every kind of planning we can to be able to mitigate these taxes, because we're going to suffer the biggest.
Great. Okay. On that note, I think we can say good evening to everybody. Thanks, Nathan. And this is recorded and it will be on. But Melissa, is it on the website or you just send down the link? I think Melissa's going to send the link out. I think.
Yeah.
Yeah.
I can send the link out. Yeah.
Yeah. Okay. Good stuff. All right. Good night, everybody. Thanks, Nathan. Appreciate it.
Bye-bye.
Bye-bye. Thank you, everyone.
Good night.
Bye-bye.
Bye.
Good evening.
Bye.